The biggest thing holding your trading back isn't your strategy. It's how you organize your analysis. In today's video, I'm going to share with you the exact scoring system that professional traders use to consistently find high probability trading opportunities. I'll also share the expensive yet very valuable lesson that I learned by trying to chase the simple trading strategy early in my career. And finally, I want to kill that myth that you have to choose between being a trend continuation trader and a counter trend trader, because you don't. And the strategy that I'm going to teach you today will prove that. All right, let's learn to trade. Let's hop into the question. I want to start by drawing the chart that the trader sent me this morning. That way it gives a little bit of a visual before we hop into things, right? Let's just do it. It's kind of like this right here. And then, so we have what type of trend is this, guys? We have a bullish trend, and he's got a zone like that. Let's call it kill zone number 1, and then a smaller zone like that, calling it kill zone number 2. So before we hop into that, let's just talk about CTS real quick, if you guys are unfamiliar with it. CTS stands for the Combined Technical Score. And the CTS system was something that was created, or at least I learned it from both of my trading mentors, Todd Brown and Jason Stapleton. Essentially what it is, it's a way to organize all of the random trading techniques and tactics that are going through your brain, right? So you learn a lot of stuff here, right? You learn about structure, you learn about, indicators, you learn about harmonic moves, AB equals CD patterns, you learn about simple patterns, double tops, right? You learn about Fibonacci's, right? The list goes on and on and on. And what happens is you pretty much have this giant tool kit with a lot of random tools in there, but you don't really know how to use it, right? What's the point of a big fancy toolkit if you don't actually know how to use the tools? So what the CTS system does is it allows you to not only organize yourself in the way that you use those tools, but it allows you to quantify what you're seeing on the charts so that you can consistently take the same opportunities, right? Imagine yourself as a trader who is trading all those things I just mentioned. And then sometimes you trade AB equals CD, but then sometimes you look for Fibonacci's, but then sometimes you're pulling up the RSI and looking for the RSI, but then other times you're looking for structure. Is there any type of consistency in that method? If you're just using a different method each time you look at the charts, right? You can insert this for any type of tactic out there. No, there's no consistency, right? And you guys know my formula. Consistent analysis plus consistent execution equals consistent results. And that's ultimately what we want. So what the CTS list does is it gives you a checklist, right? You have your, I'm not going to list all of them, but you have your structure, you have your fibs, you have your AB equals CD, you have your RSI overbought, you have your retest of structures called double top, double bottom, right? Double top, double bottom. You can even add things, right? What are some of the things that you guys add to your CTS score? I probably know what you're going to say already. You add your, right, even handle number. Let's call them psychological numbers, right? And that's the cool thing about the CTS. It isn't a mandatory type of set that you have to use. You can pick and choose what you value, right? You add your RSI divergence, Muhammad types in, right? And again, we can make this list go forever. We can shorten it. We can do whatever to it. But the point is you have this list of things. And the cool thing about this list of things is, one, it organizes your analysis. So you know that, hey, every time I look at the price chart, I know that I'm looking for structure. I know that I'm looking for Fibonacci. I know that I'm looking for AB equals CD. I know that I'm looking for RSI overbought or oversold. I know that I'm looking for double top, double bottom, psychological number, RSI divergence, whatever it may be. So there's a consistency in what you're looking at on the chart. Now, as you spoke about the other day, there are two different ways to do this, right? What happens is the CTS typically leads to a more organized style of trading. And what I mean by that is this. For me personally, the CTS was great as a newer trader because I was, like most newer traders, everywhere and I had no idea what to do. So I had all these things to play around with. I didn't know how to organize them. As I went to learning about the CTS and developing my own personal CTS, what I ended up with was I had non-negotiables. And non-negotiables were the things that had to be present in my CTS for me to take a trade. So I had to have structure each and every time. I had to have RSI overbought. I had to have double top, double bottom. And what that led to was, instead of just looking at the charts and looking for all these things, eventually it led to a strategy where I only needed those things. So instead of looking at a million things, my strategy ended up being, hey, if price action comes to structure, then look for RSI to go overbought. If RSI goes overbought, then look for double top or double bottom, and the list goes on, right? So it can lead to that, or you could look at it as a different way where you're saying, hey, I don't necessarily value any of these things more than the other, but I do need some type of combination of these things to ensure that I have a quality trade. So what you end up doing is you end up assigning each of these a score. So structure may be worth 2 points, fib may be worth 1 point, AB equals CD may be worth 1 point, RSI may be 1 point, double top, double bottom may be 2 points, psychological numbers may be 1 point, right? And then what you're saying is, hey, I don't necessarily need any individual kind of aspect of this list, but I know that in order to take a quality trade, I need at least a CTS of 4, or I need at least a CTS of 5, or at least a CTS of 6. And you can even get fancier with it, where the higher the CTS score, the bigger risk you have. So maybe a CTS of 6 is like a full risk position. Maybe you're risking a full 2%. But maybe if you have a CTS of 3, it's still a valid trading opportunity, but maybe you risk 1% instead, right? So what you end up doing is you're adding up a score. So those are two different ways that you can use the CTS. Now, with that being said, I want to get into the question that our trader brought to us here. And he says, hey, coach, I have a question. Could you take a look at this during the live room? Counter trend trading is what suits me best, which is why I want to develop and test a CTS system. I have a question about the attached chart, which is kind of what I replicated on the screen for you guys. As you can see, it is a continuation setup. In some situations, price moves into the lower part of the kill zone. That's the box that should be red, the grayish, brownish color box that I drew in, and outside structure. If I focus on counter trend trading, I wouldn't be able to take a setup like this. But I'm still doubting because price does come into a previous level of outside structure. My question is it correct that I should skip this setup if I'm focusing on counter trend trading? And then parentheses CTS. You often mention that you don't really want to make a strict distinction between trend continuation trading and counter trend trading, which is why I'm asking. I understand that the main difference lies in determining the location of where you exit the trade. So the question is, if I am defining myself as a counter trend trader, can I look for buying opportunities down here? And I want to be clear with something real quick. So when we talk about CTS, although it kind of gets confused with its combined technical scoring, but CTS can also be looked at as counter trend system, right? Is the CTS strictly trend continuation or counter trend? What would you guys say? Does a CTS trader have to be a trend continuation trader? Does it have to be a counter trend trader? No, right? So the CTS is a way of getting involved in trades. It's a technique, a tactic, a strategy for getting involved in trades. It doesn't matter what trade you get into, has more to do with your overall analysis. So the CTS can certainly be used for trend continuation entries and counter trend trading entries. And I'll show you an example of that in the beginning, or in a little bit. But just to answer this trader's questions real quick, and I want you guys to do this, if our trader is defining themselves as a counter trend trader, would they be able to look for opportunity to buy as price comes down to this lower kill zone? What would you guys say? If they're defining themselves as a counter trend trader, would this trader be able to buy as price action comes to this lower kill zone? Not asking what you would do. I'm asking based on how this trader defines. Yeah, I would say no, right? Because if we're defining this to be a trend, right? We have our 3-point move. We have our starting point to our initial structure high. We have our first outside return. We have our new structure high right here, which confirms our trend. We have another outside return. We have another new structure high. We are clearly in a bullish scenario. Taking a move right here would be a bullish trade in a bullish trend. So technically, this would be a bullish trend continuation opportunity. So again, if our trader is defining themselves as a counter trend trader only, then technically no, they should not be interested in this trade. Now, with that being said, and this is the question I always pose, I shouldn't say do we need, because you can do whatever you want as a trader, but something to consider is, do we want to brand ourselves as only counter trend or only trend continuation? And there's no wrong or right answer to that. But that's something that you have to consider, because if you're going to brand yourself as only a counter trend trader and you find that, hey, I see a lot of opportunities like this that I'd like to get involved in, well, you're going to have to sit on the sideline because you just can't get involved because technically they're not counter trend. So that may be something to consider going forward. Do I need to brand myself as only a counter trend trader? Do I need to brand myself as only a trend continuation trader? Or do I have the ability to take advantage of both? Now, let me just walk you through examples of both here when it comes to using the CTS in a counter trend trading fashion and a trend continuation fashion, right? So let's say price is doing this. We'll start with the kind of the basic counter trend trading action here, right? Price is doing this. We were in this kind of downward move, and then we shot up here, and then boom, price comes to a previous level of structure, right? Look left, structure leaves clues. I think we would all agree, right? Price action is hitting a previous level of structure. This is the area in which you would look to get involved. We could even make this a trend if you want, right? Doesn't really matter, right? Let's say a trader required structure to be hit. Let's say a trader required RSI to be overbought. Let's say a trader required RSI, a double top, and let's say a trader required RSI divergence, right? So a double top at previous level of structure with RSI overbought and RSI divergence. This would be a CTS trade that they can take. And would you guys see this as a counter trend trade? Yep. So this is where a counter trend trader would look to get involved. Price action is coming to a previous level of structure. The previous level of structure was held and not violated. And they're banking on a little bit of a relief from this level down to whatever the next level of structure is. So that's CTS trading for a counter trend trader. Let's take the same thing and remember what I did. I said structure, I said double top, RSI. Okay, we'll do the same thing for a trend continuation setup, right? The same exact CTS method, but we'll just change it a little bit. So we'll go back to the original drawing that we had on here. We have our bullish trend. We have price coming down into the level of structure. We have something like this, right? So we have price coming down into previous level of structure, check. We have RSI oversold, check. We have a double bottom, check. Let's say we have RSI divergence as well, check, right? So the same exact scenario we had in the other case, we have right here. But you guys see how this would be a trend continuation trade, correct? So again, the point I want to get across is that the method is exactly the same. We just took the same exact method, right? The same exact requirements for our CTS. The only difference that we had was the overall market condition, and that's different, right? So when we talk about our IPDE, right? The 4-step process that we always want to go through when looking at a chart. We want to identify, we want to predict, we want to decide, we want to execute. The first part of this process, the I and the P, the first half of this process, is simply setting up our directional bias. So as we identify what price is doing and we predict our future direction, that's pretty much answering the question of, hey, are we bullish, are we bearish, or are we in a continuation state? The decide and the execute, that's more of the specifics of the CTS that we just did. That is deciding, hey, what do I need to happen at there? What area am I interested in? What do I need to happen at this area? And then eventually executing the trade. So when we go through that I and that P and we establish that directional bias, that's when we are telling ourselves, hey, Akil, or insert your name. Please don't say my name. That would be weird. Hey, insert name. We are in a bullish trend and I expect this to continue bullishly. Or we are fighting against a bullish trend and this is only a counter trend play. And what that can do is that sets up our bigger trade. I can still use the CTS no matter what. But maybe the difference now is, where do I aim for profits? Obviously, with a counter trend trade, we want to be more mercenary-like. We want to get in, we want to get out, because we're only looking for that little period of relief. However, with a trend continuation trade, maybe we're shooting for bigger profits, either a bigger initial profit or maybe an extended profit, because we know that we are within the stream, the flow. What am I looking at? We're going with the direction of the river or the wind or whatever you want to call it. So that's the difference that it makes right there. But the point that I want to get across is that, yes, CTS is the method, but it has nothing to do with the overall direction. That comes from your analysis. And before I forget, I meant to say this earlier. I don't know if you guys saw it. I don't think Tom's in here, but Tom's been working on some pretty cool software and he's looking for testers, guys, right? Tom's one of the members of our platform. If you haven't met him, Tom Austin, find him on the chat. He's usually there at night when I log on. He should be on there right now, actually, but he's been working on some pretty cool software on the CTS, right? Doing all he's a coder and all that fun stuff, trying to find the optimal CTS score. He's looking for people to play around with it. So if you're interested in being a guinea pig in something that he's setting up, it may ultimately become a tool on our new platform when we launch it at the end of the month, or we'll see. Make sure you reach out to him so you can get access to this and you can play around with CTS. He's trying to find like that optimal sweet spot of like CTS score and whatnot. So just reach out to Tom on that. Yeah, it's pretty cool stuff. It's pretty cool stuff. So, but reach out for him. He's looking for testers. And that's one of the cool things about our tier one trading kind of community here. It's not just for the traders, it's for testers and developers to kind of like get ideas and have a community that they trust that can actually give them feedback instead of just putting it out there randomly on the internet and getting a whole bunch of weirdos that answer. No offense, internet weirdos. Not all of you are weirdos, but you know, some of you guys are. Yura said, I told him that I will use it when I start testing the CTS. Yeah. What it pretty much does is it's pretty much just looking at that optimal range, right? We talked about a CTS score ranging from like whatever to whatever. It's pretty much giving you that optimal range of kind of where the sweet spot is for like a good score for entries. Now, obviously you want to customize it a little bit based on kind of what you personally require. And you can do stuff like that too, but no, yeah, it's a great idea. Before we jump back into the lesson, I want to remind you guys that today's conversation actually came from one of the live trading rooms that we run over at Tier 1 Trading. We do them 2 times a day, 3 times a week. So if you ever want to hop in with a like-minded community of traders, feel free to check us out. Just head over to www.tier1trading.com, sign up with your risk-free 14-day trial membership, gets you on the platform. You can check out the live rooms and all the other educational resources that we have as well. All right, back to the video. Yura says, how does it work during periods of consolidation since there's no trend to determine? Good question. So how would the CTS work during a period of consolidation? Let's just draw out a nasty period of consolidation right here. What would you guys say? During a period of consolidation, how would it work? I'll give you 2 options. Trend or counter trend. It might be easier once I give you the 2 options. Trend or counter trend. So let's start off by this. Let's define when we are in consolidation, are we in a trend? Right? We have 2 options, trend or counter trend. We have trend and then we have counter trend. So if we are in consolidation, we're not in a trend. We can all agree about that. So right away, we're not looking for trend continuation. So that just leaves one way to go about it. You take a counter trend approach, right? So if the market is consolidating back and forth, we're in a channel, perhaps. You saw us on the Aussie Canada the other day, right? Maybe we can take a look at that. Or maybe we're just in the sloppy, choppy markets. We take a counter trend approach where, okay, well, we've identified a level of structure. We're not looking for any type of trending reason here. So we're looking for just a counter trend move at a previous level of structure, right? So this is what I talk to when you guys will hear me refer to this in a live room a lot when I say, structure to structure trading. And as I've gotten old and gray in my trading career, I no longer define myself as a trend continuation or a counter trend trader. It's more of kind of a structure to structure trader. So what I do when I go into the charts is I identify where was our most recent level of structure, where is our current level of structure, where is our next level of structure, and my expectation is that price will go from one level to the other. So it's the same thing here with counter trend or with consolidation. You're not looking for any type of continuation move unless you're predicting a breakout, whatever like that. But you're looking for it to move. You're looking for price action to get to a previous level of structure. You're looking for it to hold a level of structure. And then you're projecting a move off of this level of structure to wherever that projection is, if there's room. Again, Aussie Canada has been a good one for consolidation as of late. Where are you, my Aussie Canada? There you go. You can see that after our directional move here, right, we've kind of just bounced sideways, right? I think we would all agree, period of consolidation, guys. The sideways shuffle, the crab trader, right? So you can see, right, what have we done multiple times? Well, we've hit these tops. What have we done multiple times? We've hit these bottoms, right? These are all counter trend CTS type trades, right? Now, again, if you don't have a directional bias, you're trying to get in and out. You're not looking to hold these for any type of breakout unless your directional bias says that. But you can easily trade it from just, hey, price action hit a previous level of structure. Let's look for an opportunity here. Price action came down to a previous level of structure. Let's look for an opportunity down here. And then just do that across the board. So you can still take advantage of counter trend trading scenarios. The biggest difference that you have to make is going to be your target projection, just making sure you're smart with targets. And again, I mentioned this in the video the other day about playing trading defense. One of the biggest issues I see with a lot of newer traders isn't necessarily their ability to find good trading opportunities. It's just they mess up on targets. So an example would be this. Let's say you take a trade right up here, right? You've got your narrow range bar in gold here, your NR7. Let's say you take a narrow range breakout to the downside, right? We are clearly in a period of consolidation. Just want to confirm that again, right? No one thinks otherwise. If anything, you would say maybe a bullish trend, but from what happened previously. But yeah, so the biggest difference I see is this. If you are looking at this as a CTS counter trend trader, for example, where are you likely taking targets at? And I know it's easy to see in hindsight, but be honest with yourself. Like, are you taking it? You're probably taking it maybe somewhere in, somewhere in the middle or across the whole range. Would I agree? One of these two areas? Is anyone doing anything different here? You real conservative traders like, right in the middle, more aggressive across the range. Give me a yes if I'm right there for you guys. If that makes sense. And that comes from, yes, good. That comes from identifying the state of the market that we're in. That comes from saying that, hey, man, we're bouncing back and forth across this channel. I project a move off these highs, but I don't really have any bigger expectations, so let's play it safe. One of the biggest mistakes that I see, again, newer traders make is they'll take a trade right here, which is the perfect location to take a trade, but then they'll shoot for targets like down here somewhere. And it's like, it sucks. And I've been here before as well, because you're right in your prediction, but you don't make any money because the market never goes to where you expect it to go to. And it's just because they have the wrong expectation from the trade. And that goes back to the basics of reading a price chart and understanding what condition the market is. And now that I think about it, most newer traders don't do that. Most newer traders never learn how to read a price chart, do that. They just learn how to find the signal. Like, what's the entry signal? What's the method? And they have that method, and therefore they're good at entering with that method. But because they don't actually know how to read a price chart, Foundation 1 and Foundation 2 stuff, right? They can't actually make the determination of, hey, should I be in and out? Should I hold for longer? Are we overall bullish? Are we overall bearish? Are we in consolidation? And that hurts both their target projection and their stop placement. And then they either lose money or don't make money, all because you haven't learned the basics, right? So, yes, you can certainly take advantage of it in consolidation. Just be aware that we are in consolidation and you want to be more conservative with your targets based on if you were in like a full-blown trending opportunity where the expectation is that we would kind of break through structure and continue on the way down. Another question came in. Does it make sense that I shouldn't classify myself as a counter trend or trend continuation trader, but rather as a trader who wants to trade outside levels of structure? But wouldn't that mean I'm mixing things together and making them confusing? So that is only a question that you can answer, right? And that is fully based off of what type of trader do you want to be. So if you have the desire to only take trend continuation scenarios, that's fine. And you can define yourself as only a trend continuation trader. If you have the desire to only take counter trend trading scenarios and you want to define yourself as a counter trend trader, then that is fine as well, right? There's no wrong answer to this stuff. Can you do both? You certainly can. And it wouldn't really be mixing signals together until there is a balance that you have to have. And this is what I ran into with the Fibonacci failure strategy. And I'll walk you through that in a little bit. But the initial signal wouldn't be mixed. And I'll show you what I mean. So let's go back to our line chart right here. Let's do a trend continuation approach, because this is going to be the most basic one, right? So, and I'll show you where the dilemma comes in. And this was something that I learned in my trading career too. So, do I want to do my lesson first? Yeah, I'll do my lesson first, right? So, I told you this story before. I used to trade. This is back when I was a younger trader and I was not really looking to learn how to read the markets, as I just mentioned, but looking for a quick strategy. And by quick strategy, I mean, I was looking for the easiest strategy that I can pick up and trade right away. And I tried like 5 of them and it didn't work because it was their fault, not my fault, of course. But I eventually landed on something called the Fibonacci failure strategy. And the Fibonacci failure strategy was a trend continuation strategy where step 1 was identify the trend. Would you guys agree? 3-point move, trend, starting point, initial structure high, outside return, new structure high confirms the trend. Here's what I would do. This is very simple. Don't laugh at me. It was a real thing. I would take my Fibonacci retracement from our previous outside return to our latest new structure high, so the last swing. And the Fibonacci failure strategy said this. We would look for price action to retrace to a minimum of the 382, and we couldn't go past the 618. Right? So our stop loss would end up being below the 618 right here. So this was our stop loss. And what would happen is, let me just change this font real quick. It's bothering me. I want it to be a little darker. There we go. What we would do is we would look for our reason for entry within the zone between 382 and the 618. And then we would just buy. And we would shoot for the next extension, looking for a 127 for target 1 and a 1618 for target 2. So I would take my Fibonacci extension tool from that same swing that we measured, swing low to swing high and back down. And then the target 1 would be right here at the 127 and the target 2 would be at the 1618. Doesn't get any simpler than that, does it? Can you guys see why I was so attracted to it as a younger trader who maybe didn't want to put in the work needed to actually be a good trader? Yeah, pretty simple, right? And you can see the risk reward was, pretty decent. If I get involved, let's just say at the 50% here on average, I've got a little bit of stop loss that looks like this. This is a basic trend continuation strategy. My target 1 is up here. I've got a pretty remarkable risk reward, right? Even if I get in at the 3D2, which is like the lowest point I can possibly get in, right? My risk reward on average is pretty crazy, right? So I was all googly eyed and counting my money and counting the days before becoming a millionaire, right? Now, the problem was this. At the time, I was also a counter trend trader, right? So I was a counter trend trader that would look for trades at structure, right? So if I just kind of shimmy this to the side real quick, I was a counter trend trader who would look to take trades that tested previous levels of structure, held at previous levels of structure, and then look for this little move right off there, all right? So can you guys see the dilemma yet here? And this is the thing you need to consider and make rules around. So if my target is the 127, we would all agree that means price action has to create a new extension. At some point, as price action is creating this new extension, we are going to come into our previous structure high. That's the nature of a trend, right? An extension needs to break past a previous level of structure and keep going. And sometimes we get that breakout right away, right? We can look on charts, and sometimes we just boom, break out past previous levels of structure. Sometimes we kind of pause and hold here before doing stuff. So the issue that came for me came during the areas where we would pause and hold. Going back to our original example, what if price rallied up? What if price gave us a double top? What if price gave us RSI overbought? What if price gave us RSI divergence? Now what do? I am already in my bullish position from down here, but now all of a sudden I'm getting a bearish signal. I've got a few options, right? I'm going to put a poll question up for you guys, and I want you to answer it for me. Give me a second to get the songs. I always mess it up. Poll is published. Let me know what you think. You should be seeing it. What do you do? Do you stick with your first trade, which is the trend continuation trade, the bullish one? Do you exit your first trade and then reverse into the bearish opportunity, because that is a completely valid signal as well? Or at this point, are you like, I don't know what to do? We'll give you guys about 10 more seconds to answer, and then we'll get that in. All right, so you guys can see the results said what? 72% of you guys said stick with the first trade. About 20% of you guys said or 18% of you guys said exit the first one and reverse. And 9% of you guys said, I have no idea. And the reality is every answer is wrong, because you don't have rules on how to handle it. So if you stick with the first trade, you're breaking a rule because you're ignoring a valid trading signal in the second one. If you exit the first one, your initial trade, you're breaking a rule because you're now exiting a trade early, right? Remember this delicious profit we talked about you getting? Well, all of a sudden, if you exit short, that risk reward isn't the same, right? And I showed you guys the risk reward kind of graph and chart yesterday about what happens if you sabotage your risk reward. Your win percentage has to rise up to meet that, and you're not necessarily increasing your win percentage on something. So, and if you have no idea, then you don't take any action, or I don't know what you do in the market. You just have no idea, right? So there's no right answer. And what I would personally do back in the day is I would let my emotions dictate the decision, which is the absolute worst thing you want to do. But again, I was a younger, dumber trader, and that's what I would do. And what I mean by that is however I felt from the previous trade, that thought would stick with me, and I would take that action into the next trade. So if the trade before this gave me a double top and then rallied down, and let's say I stuck with the initial trade and I'm crying because I got stopped out, and then I'm crying because I missed money on the downward trade, I would remember that. And then the next one, I would reverse, right? I would exit my position and reverse early because I didn't want to get burnt again. And then, of course, what would happen on that trade where I exited my long and reversed early? What would it do? You know how market karma works. It would go up. So then I'd be like, damn it, I missed my blah, blah, blah. So next time it would happen, right? I would not exit early. I'd be like, last time I exited early and you kept going up, I'm going to ignore the counter trend trading signal this time. And then what would happen? The market would go down. Damn it, right? So I was always behind it because I was always making random decisions, and you get killed by randomness in the market. So if you want to do both, right, that is going to be the dilemma that you're going to have to deal with. And that comes into organizing your trading plan. And that means you have to set up your trading plan in a way where you don't have this dilemma. That's why if you notice in my trading plan, right, I don't call myself a true trend continuation trader because, right, can I take targets at an extension, guys? You guys know my style by now. You've been here every day with me. Can I look for extensions with my initial targets? No, I cannot, right? Because that is a rule that I had to put in to stop from any conflict of interest. So I had to, and for me, I'm counter trend first. So I don't, you can value whichever one you want to value. It doesn't really matter. But for me, I'm a counter trend trader first and foremost. Trend continuation trading is my secondary style. So that's the one that had to be adjusted around my counter trend rules. So I just made simple adjustments to that, not to have any conflict of interest. So that you can certainly do both, but that's what you would have to do in that scenario, is just make sure you organize your rules. And of course, we can work with that in the Q&A, so that you don't have the conflict of interest. But you're not going to have two different signals at the same time. The only dilemma that you may have is you may be in a trade where a secondary signal occurs. And like in most cases, right, we do deal with this with patterns as well. My rule is like, hey, if once I'm in a trade, I stay in that trade until the trade is complete. So I never exit a working trade because of a quote unquote opposite signal. I let that trade play out. And that's a very easy rule to put in if you want to have that rule in there. Here says, I basically just want to trade outside levels of structure and use CTS techniques alongside that. I want to include all of these in my testing and see which combination gets the best results. Yeah. You can trade outside levels of structure doing both. Yeah, right? It doesn't matter. Look, you can trade, if just taking this chart again, if price action comes down here, you can trade this outside level of structure, right? This is an outside level of structure. Can you trade it bullishly here? Darn right you can. If price action came from this level and retraced up to here, or extended up to here, excuse me, and you got a signal up here, is this an outside level of structure? Hell yeah, it is. You can trade that as well. You can trade both. Yep. You can trade short up here. Yep. You can trade long down here. Right? Again, the only main concern that you're gonna have to think about is on your trend continuation trades, you're gonna have to think about, where do I take targets at? And again, for me, I take targets up here, right? Again, my targets come at the first level of structure. So I don't look for extensions. Again, that helps me, have any get rid of any conflict of interest. I don't look for extensions. I look with initial targets, right? But yeah, you can certainly trade both, and this will give you the ability to trade trend continuation, counter trend, market consolidation, really any type of market condition there is. Again, you just want to be aware of, in my opinion, the overall, always do your top-down analysis, the overall market condition first, because that's going to help you dictate how far you should look for profits on the particular trading situation. One last question. Ooh, yes, I love it. Dry day today, so I bring them on. Now, if you got a little bit confused or overwhelmed about the whole trending or not trending thing, don't worry. It's not a negative. It's just a sign that you need a stronger foundation. And to build that foundation, make sure you check out this next video on how to properly read a price chart, or check out this new trader playlist with all other types of goodies on there. All right, I'll see you guys next video. Like, subscribe, hype me up. And until next time, plan your trade your plan. Take care.